Okay, so you wake up, you check the news, and it's kind of the same old story, right? Inflation is still biting, rent seems to go up every other month, and you probably know someone, maybe it's even you, who's struggling to find a really stable, good job.
Yeah, that sounds familiar.
But then you glance over at the stock market ticker, and it's like a totally different universe. I mean, the market's booming. You see the NASDAQ like moonwalking, the S&P doing backflips, the Dow is flirting with record highs.
Right.
And you just have to ask, what the hell is going on?
Yeah, that's a disconnect, isn't it?
Exactly. The article we're digging into today calls it this new American contradiction. You've got the market, dancing like crazy, while the real economy feels like it's choking on student debt, wages that aren't keeping up, and, I don't know, $7 eggs?
It's a stark contrast.
It really is. The article frames it as this widening canyon. Like, if the market and the economy were a couple, they'd definitely be in therapy by now, right? Blaming each other for communication issues.
Yeah, probably.
So the mission for this deep dive is basically to unpack what's fueling this gap, this fantasy land on Wall Street versus the reality on Main Street, the rent anxiety, all of that. We're pulling from a recent piece that really dives into this dystopian split.
And we're going to guide you through the main reasons behind this disconnect, hopefully uncover some maybe surprising things and challenge some common ideas about how the economy actually works.
Okay, let's unpack this then. We really have to start with a key point, I think, a fundamental misconception maybe, and that is the stock market is not the economy.
Right, that's crucial.
I mean, it never really was the perfect mirror, but the article suggests lately it's like it doesn't even know the economy, like they're strangers.
Well, yeah, and a big part of that is the market's always looking ahead. It's inherently forward-looking. The article uses this funny analogy like a stoned fortune teller at Coachella, right?
Okay.
It cares about things like Microsoft's cloud growth, but like 3 quarters from now,
Yeah.
or how much AI buzzword bingo NVIDIA can pull off next year.
So future potential, not current pain.
Exactly. It's less about your bills today and more about projected profits down the road. And then there's the whole algorithm economy thing.
Ah, right. Explain that.
So a huge chunk of the market now is run by, high-frequency trading algorithms, big institutional funds.
Right.
These aren't people weighing your personal situation.
Yeah.
These are machines trading on signals like liquidity, sentiment, momentum, but not on your grocery bill going up.
Right. Not on my rent increase.
Definitely not on your rent increase or, your cousin struggling to find work. The inputs are different. A tiny hint of a potential rate cut.
Stocks throw a party.
Exactly. Someone mentions AI and productivity in the same sentence.
Stocks start twerking, as the article put it.
Yeah, and even bad news, like whispers of a recession. For some of these systems, that's just a buying opportunity, baby.
Wow. Okay, so that's the markets world. Let's pivot then. What about the real economy? The one, we actually live in day to day. What's the source material saying about that?
Well, it paints a pretty sobering picture in places. It talks about wage growth versus inflation as kind of a sad story, really.
How so?
Okay, so the stark example given is, let's say your salary went up 4%. Seems okay, right?
On paper, yeah.
But if your actual cost of living, rent, food, gas, everything went up 7% in that same period, well, congratulations, you're now 3% deeper into the I can't afford to live hole.
Ouch. Yeah, that math doesn't work out well.
No, it really doesn't. And then you layer on things like healthcare costs. The article points out, the only thing growing faster than hospital bills sometimes feels like your rage when the insurance company puts you on hold.
Uh-huh. Tell me about it. What about jobs? The unemployment number looks pretty good usually.
Yeah, and that's another point the article really digs into how the numbers can lie, or at least not tell the full story. That official unemployment rate, well, it looks good on paper.
It misses things.
It misses a lot, according to the source. It ignores underemployment people working part-time who want full-time. It ignores the instability of the gig economy. It ignores the fact that, seemingly everyone from your Uber driver to your DoorDash delivery person might have a master's degree but can't find work in their field.
So qualified people doing jobs below their skill level just to get by?
Exactly. And it points out that millions are either juggling multiple jobs just to scrape together enough income, or they've dropped out of the workforce entirely. Maybe they gave up looking, or maybe they just literally can't afford childcare, so working isn't even an option.
So that official 3.9% unemployment rate, the one we hear quoted all the time like it's gospel,
Mhm.
what does that really mean for the average person feeling these pressures based on what the article's saying?
It means the headline number can mask a lot of underlying stress and precariousness in the labor market. It's not the whole picture.
Okay. And the article also talks about corporations, right? How their success doesn't always trickle down.
Right. This idea that corporate earnings don't equal national well-being, it highlights this pretty striking trend. Record profits, record layoffs.
That seems counterintuitive.
It does, but the article cites examples like Amazon and Meta posting absolutely record-breaking profits and then turning around and announcing massive layoffs almost right afterwards.
Why would they do that?
Well, the analysis suggests it often comes down to shareholders. Shareholders don't really care about your mortgage payment. They care about EPS earnings per share. And if firing, say, 10,000 people makes that EPS number go up, makes the stock look better.
Then that's the decision.
That's often the decision. The article calls it capitalism's version of ghosting. It's not you, it's the margin.
Wow. That's harsh.
It is.
Yeah.
And related to that is the point about buybacks over benefits,
Mhm.
meaning companies have often taken their excess cash, their big profits, and instead of reinvesting it in their workers, better wages, better benefits, more job security.
Or even just R&D or building new factories.
Right, or reinvesting in the communities where they operate.
Mhm.
They use that cash for stock buybacks. They buy back their own shares.
Which boosts the share price.
Exactly. It boosts the share price, which makes the remaining shares more valuable, and often boosts executive bonuses, which are tied to stock performance. The idea of using that money for workers or communities, the article kind of dismissively says, LOL, get out of here with that socialist talk.
So prioritizing shareholder value above almost everything else.
That seems to be the trend highlighted, yes.
Okay, here's where, as the article says, it gets really interesting.
Mhm.
Let's talk about the Fed. The Federal Reserve, interest rates, this whole monetary Mad Hatter's Tea Party.
Right. The Fed is presented as kind of the puppet master of the markets here.
How so?
Well, monetary policy sets the cost of borrowing money, right? And investors hang on every single whisper from the Fed chair, Jerome Powell, like it's a spoiler for the next Marvel movie. Every word is analyzed.
And this ties into the rate cut addiction.
Precisely. The article argues that years of near-zero interest rates basically inflated these massive asset bubbles. Things got so bloated they were like floating above reality, like that house in the movie Up.
Okay, I can picture that.
Then when the Fed had to hike rates really fast to fight inflation, the market basically threw a tantrum.
Yeah, I remember that.
And now, the slightest hint that the economy might be slowing down or inflation might be easing, and Wall Street just starts salivating at the idea of a pivot, a return to rate cuts. They're checking Fed statements for any sign. Powell might be feeling dovish, leaning towards cuts, with this desperation usually reserved for checking an ex's Instagram.
Ah, okay. But what about the real-world impact of these rates?
Well, that's the other side of the coin the article really stresses. While Wall Street is hoping for lower rates to boost stocks, higher rates have already made mortgages unaffordable for a lot of people.
Definitely felt that.
Right. Credit card debt becomes way more expensive and harder to pay off. Small businesses find it much tougher to get loans to expand or even just operate.
So the Fed's actions have these huge real-world consequences.
Absolutely. But the market focus, the article implies, is often just on whether NVIDIA hits $1 trillion valuation. It's like, as long as that happens, it's all good, right?
Yeah.
Which ignores the pain elsewhere.
Let's talk about the little guy for a second. Retail investors. During the pandemic, there was this whole David versus Goliath thing. Meme stocks like GameStop and AMC.
Oh, yeah. Diamond hands became like a religion. Hold on, don't sell.
Right. It felt like maybe the small investors could actually win for once.
But then came the crash. And the article's take is pretty blunt. Turns out Goliath was the house. And the house always wins.
So the institutions came out on top again.
Largely, yes. And many retail investors, the source suggests, are now just left bag-holding stocks like Palantir, AMC, or maybe even an NFT of a monkey smoking a joint that's worth a fraction of what they paid.
Oof. Okay, and now there's a new hype cycle, AI.
Exactly. The article calls AI mania the latest financial fever dream. It compares it to the dot-com bubble back in the 2000s.
Oh, so?
Well, the example given is almost comical. You take any company, slap the letters AI somewhere in its business description, and boom, the stock jumps 30% overnight.
Even if it doesn't really make sense.
Yeah, like the joke example. A paperclip company adds ChatGPT to its website and calls itself an AI-driven paper experience platform. Market reaction. rockets emojis.
Ah, so pure hype-driving valuations.
Well, the article clarifies the idea that AI could genuinely increase productivity and efficiency is very real. That potential is there.
What?
But the valuation premiums, how much extra people are willing to pay for these stocks right now, have raced way, way ahead of any actual demonstrated earnings growth from AI so far for many companies.
So the market's betting big on a future that hasn't arrived yet.
Essentially, yes. Huge bet.
And yet, back on Main Street, the question remains, can I afford groceries this week? That disconnect again.
It keeps coming back to that, doesn't it? The article also mentions how confusing even the big economic indicators are right now.
Like GDP.
Like GDP versus GDI. Gross domestic product might say the economy is growing, but gross domestic income, which theoretically should match GDP but is calculated differently, might suggest we're actually in a slump.
So the signals are crossed.
Totally crossed. The article says even the economists are confused, looking at the data going WTF, basically. It's hard to get a clear read.
Okay, so if we try and connect all these dots, pull back for the bigger picture, what does the article say is the real, maybe the deepest reason for this divergence? Mark it up, people struggling.
It points pretty directly at wealth inequality. That's framed as the truest reason the market keeps rising while most people feel like they're drowning.
How does that work?
It boils down to who actually owns the assets that are going up. The article cites a really powerful stat. The top 10% of households own something like 89% of all stocks in the U.S.
Wow, 89%.
89%. So when the market goes up, sure, maybe your 401k gets a little bump, which is nice. But the vast, vast majority of that wealth creation, it's accruing to a tiny sliver of society that already holds most of the assets.
So the gains aren't broadly shared.
Not nearly enough to offset rising costs for most people.
So the article's analogy, if the market is a thermometer.
It's taking the temperature of the yacht club, not your living room. That's the core message.
Okay, that makes a painful kind of sense. What about how people feel? Consumer confidence.
Yeah, the article calls consumer confidence surveys a two-faced beast. It compares trying to judge the economy based on these surveys to, like, judging a marriage's health based on how often the couple posts happy pictures on Instagram.
Not always reliable then.
Not always reliable. People might say they're pessimistic about the economy in a survey.
But then they keep spending.
Maybe it's YOLO economics, maybe it's necessity, maybe it's just putting it on the credit card. And the article notes credit card debt is at all-time highs. So people are spending, but maybe not sustainably.
Okay. And housing, that's always a huge issue.
Oh, the real estate market gets called a tragic comedy.
Yeah.
Prices are still sky high in most places.
Yep.
Mortgage rates have basically doubled from their lows.
Making it even harder to buy.
Exactly. And inventory, the number of houses actually for sale, is described as a joke. It's incredibly low.
But why aren't prices falling if rates are so high? Shouldn't that cool things down?
You'd think so, but the article explains a few reasons why they're sticky. One, existing homeowners who have super low mortgage rates, they refuse to sell and give up that rate, so they stay put.
The golden handcuffs effect.
Right. Two, institutional investors, big companies, are still out there gobbling up homes, often paying cash, competing with regular buyers. And three, the article suggests the Fed and policymakers seem, maybe allergic to solving the real deep-seated housing supply problems. So you end up with this situation where, like, a Gen Z person just wants a studio apartment that doesn't double as a roach motel, and it feels impossible.
Yeah, that feels very real for a lot of people. What about politics in all this?
Politics gets described as mostly gridlock and gaslighting.
Sounds about right.
Both parties toss these economic grenades back and forth, blaming each other. But the article argues neither side seems capable or maybe willing to really tackle the big long-term structural issues like wage stagnation that's been going on for decades, or the housing affordability crisis, or the absolutely absurd cost of childcare in the U.S. Instead, the focus seems to be on
TikTok bans and book removals.
pretty much stuff that gets headlines but doesn't really address why your avocado toast now costs $14.
Okay, last piece here, the media's role.
Yeah, the article talks about media echo chambers and the illusion of prosperity. Financial news outlets, it points out, they love a bull market.
Why is that?
Optimism sells ads. People are more interested. Viewership goes up. Good news is good business for them.
But
the critical point is that the people watching CNBC or Bloomberg all day, tracking those tickers closely, they generally don't reflect the average worker's financial situation.
right, they're more likely to be in that top 10%.
Exactly. So you get this coverage celebrating the market highs, but you rarely hear, Jim Cramer saying, well, the S&P's up 500 points, but half the country still lives paycheck to paycheck and can't afford an emergency. That part gets left out.
Creating a skewed perception of how things are really going.
That's the argument, yeah.
Mm-hmm.
An illusion of widespread prosperity driven by the market's performance.
Okay, so let's try and wrap this up. We've covered a lot of ground. What does this all mean, this huge gap?
Well, the core takeaway from the source material seems to be that this divergence, this split between the stock market and the real economy, isn't just some weird statistical quirk. It's a symptom of something. Well, something broken in the system.
Yeah, it feels that way when markets are soaring, but most people can't even dream of affording a starter home.
Right. Or when CEOs are getting paid 300 times what their average worker makes, but they're still cutting jobs to boost profits.
Or when AI stocks explode based on future promises, while actual human jobs feel more precarious or might even evaporate.
It forces you to ask that really fundamental, almost existential question the source poses. Who is the market actually for?
And the implied answer is?
Because, based on everything we've discussed, the article concludes it sure doesn't seem to be for the average American anymore. Not primarily, anyway.
So, if we were to dream for a second, based on the problems highlighted, what would need to change? Even if, as the article suggests, it probably won't.
Well, you could imagine things like actually linking CEO pay not just to the stock price, but to long-term worker outcomes, like wage growth or job security within the company.
Okay, that's interesting.
Or implementing some kind of real progressive tax reform that addresses the massive concentration of wealth at the very top.
Right.
Maybe finding ways to seriously incentivize companies to reinvest profits back into American jobs, training, communities, instead of just buybacks.
Makes sense.
And, of course, massive, serious investment in things people actually need. Affordable housing, healthcare, education, strengthening the real economy.
And maybe pump the brakes on the AI hype a little.
Yeah, maybe rein in the AI hype before we, create a hallucinated GDP based on hallucinated products, as the article cheekily suggests. Ensure growth is tied to reality.
But let's be real, as the expert source kind of implies.
Yeah, let's be real. The tone suggests Wall Street doesn't really want fundamental change. It wants more rate cuts, more hopium, more fuel for the market rally.
And more distance from that pesky little thing we call reality.
Pretty much. Keep the party going, even if the foundation is shaky.
So here's a final thought, maybe something for you, the listener, to mull over next time you see this contradiction playing out. Next time someone says, but the market is doing great.
Feel free to respond.
Cool. So are my landlord's rent increases. Want to invest in those too.
Yeah. It puts it in perspective, doesn't it?
It really does.
Because the ultimate point seems to be, until we start building an economy that actually reflects and supports human lives, health, stability, opportunity, and not just shareholder dreams or abstract market metrics.
We're all just kind of stuck.
We're all just passengers on this roller coaster we didn't really sign up for. And the exit, well, the article implies it's been closed for renovation since about 2008.
A sobering thought to end on. Thank you for joining us on this deep dive.